moment. Is there a piece of advice you'd give people looking in this current market?
Yeah, I would say, and I feel like we're people in this current market that are looking, and the advice I'd give myself is be patient, look for value, and work with people that you trust.
Hey everybody, welcome back to another episode of Wealth Unfiltered. I'm Samantha Parinello, your host, and I'm here again with my resident guest expert, Chris Parinello. Today, we're diving into a metric that not only helps you build your wealth, but also lets it grow for you. We're talking about cash flow, and this metric is vital for early retirement and how to gain true financial freedom. So what is cash flow? Cash flow is the money that works for you and that you keep receiving even if you're not working. So, Chris, why don't you break it down a little bit further for them?
Yeah, I mean, you've heard it in different industries. People call it mailbox money. People call it yield. It's going to be your immediate return on investment. In many investment structures, it's a component of a broader total ROI. And most sophisticated investors understand that there's an emphasis on cash flow because cash is king.
Cash is king. And, especially when you look at the world of, well, I should say really when you look at the two different styles of investments, there's the traditional equities, your stocks and bonds, and then there's multifamily. So it can become a very powerful tool when you're looking at multifamily passive investing.
Yeah, and I would argue that it's similar in all three of those. With multifamily, you're usually you compare everything to what you would consider, who knows these days, but a risk-free asset. So if you look at a bond like a treasury yield, you know that you're going to have a certain annual return, and there isn't going to be back end. And you're saying, okay, if I can invest in this risk-free and grow my money slowly, what could I get if I take on a little bit more risk? What happens if I mitigate that risk? What if I feel like I structure through non-correlated assets and different types of assets and a way for me to have strong cash flow and a lot of back-end upside that may or may not be realized? With stocks, you're doing the exact same thing, and you have some different types of stocks. Some pay a dividend. That's going to be sort of like the cash flow you get from multifamily deal. So, for instance, take something like Lockheed Martin. You can do a direct reinvestment program with a company like that. It's stock that we own, blue chip stock. And the way a DRIP program or direct reinvestment program works with some of these big blue chip stocks is not only do they pay you a dividend, but you can tell the company, I want that dividend to automatically get reinvested into more stock. So you could keep the dividend or you could reinvest it back into the company. You reinvest it back into the company, you get kind of exponential growth because you're getting now the money that you made from your original money is making you more money.
Right.
And that's one great way of investing through stocks. That's how my dad taught me. With multifamily, it's a little bit different, but the same principle could apply. When you look at multifamily and you compare it to a risk-free asset, what a lot of folks are trying to do is they're trying to say, okay, if I can get the 4 or 5% yield that I get from a bond in my cash on cash, and I get 70% of the profits at disposition, and according to the underwriting with assumptions that I believe in because I did my due diligence properly, I think that not only am I going to get this 5% yield, but I have a pretty good chance of getting another 10, 12%. And that would be on kind of an average annual return basis. Now that cash flow you get early on, because you're getting it earlier, will actually increase your return from an IRR perspective. It takes the time value of money in. And I think that's why cash flow is king, because the time value of money, if you're getting money back every single quarter or every single month, then that money can be redeployed and make more money.
Right.
If you have to wait 3 years to get any of your money back, you need to be getting a premium on your return because you're losing the opportunity cost is that you're not able to reinvest that money until you get that lump sum payment at the end. So this is the difference when you compare a stock like Lockheed Martin that pays a 3% dividend sometimes, and something like Tesla, which very rarely pays a dividend, but it's a high growth stock.
Right.
So think about multifamily acquisitions versus multifamily development. Similar concept. Your value add property might give you 5 to 7% cash flow on a monthly, quarterly basis. But it's going to take 5 to 10 years for you to double your money. A development deal, no cash flow. There's no renters in a building that has yet to be built.
Right.
There's no cash flow. There's no revenue, but you're getting it at the best basis you could ever get because you're building from dirt.
Right.
You're taking the risk of the land. You're doing all of that. And you might be doubling your money in good times, 2.5x in 3 years. So it's all relative. But when you look at cash flow, the important thing is to make sure that you're building your portfolio to give you the cash flow that you need based off of your situation.
Right. Yeah. I think specifically for people who are at the age where, they are looking for retirement or early retirement, it can become very, very powerful for them because, we were just discussing an investor, I think earlier this week, where he wants to retire and he wants to put a large amount of money into a multifamily investment so that he can, and his priority was cash flow. And he made it very clear it was cash flow. And the reason for that was because he really wanted to be able to retire sooner than he had first anticipated, spend more time with his children. And by doing that, he was going to receive the type of almost income, it's a passive income, but an income for him that then he could quit his job now.
Right. And that's exactly it. So when I look through the investment classes in a typical Viking deal, and I'm talking to investors, the way that I was taught to look at this is, what's your time horizon and how badly do you need the money? So if you are, like, for instance, if we were setting up a future investment account for Ella.
That's our daughter.
8 years old, time horizon, another 80 years. You would take a little bit more risk and you would not prioritize cash flow because what's she going to do with it? Unless you're just trying to maximize cash flow so you can reinvest it and you're just hyper vigilant about doing that, then I would say those types of growth stocks, things that you think like a lot of people are shying away from some of the big stocks like Nvidia and Tesla and the Mag 7. And you'd ask, well, people are going to be the future of AI. Why are they shying away? Why are big institutions pulling money away? And the answer is that nobody wants to get stuck holding that stock with capital that they need in the next 10 years.
Right.
So, and that's the thing. If we were buying and starting a stock portfolio for Ella, we'd say, okay, cool, put $100 or $100,000 in Nvidia stock, and I'm pretty sure that Nvidia is going to be involved with the AI revolution that might happen over the next 30 or 40 years. You never plan to touch it.
Right. It's more like set it and forget it.
If you're a hedge fund and you're trying to make your money off of margins and calls and puts, you might be a little bit scared. Like, what happens if Trump throws another 670,000% tariff on semiconductors, and the thing tanks, and I need to actually move my shares of this to another part of my portfolio. So that's one area of risk a lot of people don't think about is time. How quickly are you going to need the money? So if you have the time horizon and you don't think you need the cash and you've evaluated the risks, I would say a nice blend of getting cash flow and back end upside is the right way to go.
Would you say that there is more risk in one strategy or the other, whether it's cash flow or appreciation?
I would say it's not so much that there's more risk, you just delayed gratification, which should carry a premium. So just like risk should carry a premium. So if you're in a highly risky asset and you're not going to get any cash flow, you should be getting a pretty penny.
Right.
If you're in a very safe asset and you're going to have to wait 3 to 5 years, or think about they used to do this in conjunction with EB5 a lot. The opportunity zones.
Oh, yeah. Yeah.
So opportunity zones, really cool product. Government came out and said, if you invest in an opportunity zone, leave your money, invest it in that opportunity zone for 10 years, you'll avoid paying taxes on it.
Oh, what a benefit.
And the goal would be that you get a nice tax arbitrage. You sell your company, you get $5 million, you put it into an opportunity zone. It's going to grow because it's in an investment that's going to create returns, and you don't pay taxes on any of it because you left it there for 10 years. You helped that area that was in need of opportunity, like a rebuilding, gentrifying area, qualified. But 10 years of your money being illiquid is a long time.
Yeah.
Works well with real estate because typically sophisticated real estate sponsors and investors usually underwrite to 7 to 10 years, and in good times try to sell in 3 and 5. But that is the kind of the time value aspect.
Right. And I've quoted this before, but Warren Buffett's favorite quote is, or like, not his quote, his favorite timeline is forever, like investing in forever. He's like, you don't pull your money, although like we've recently seen him do that. But I mean, he was invested for a very, very, very long time in most of his stocks. He loves having 20, 30-year time horizons.
Right. Well, and he didn't, even though he's carrying a really high cash position, which we've talked on other episodes.
Yeah.
He didn't completely cash out of all of those shares.
No.
I think he did like what a smart poker player would do, or someone, that understands the ebbs and flows of different markets, has seen multiple cycles in real estate, in traditional equities. And he's saying the real estate market's pretty frothy right now. The fundamentals don't really make a ton of sense. You're looking at 30, 35 times earnings. Like, I don't think they're going to go to 50 times earnings. Let me pull some of my chips off the table, see how everyone else plays their hand. And if
figure out where to
valuations go down, I'm sitting on a bunch of cash because cash is king.
Because cash is king. Yeah. And there is a ton of people who, specifically in the real estate world, I think, who've been on the sidelines, for 2, 3, 4 years now, that have been waiting out what's been going on there. But now with all of the economic uncertainty going on in the stock market, I think we're going to see even more, like you were saying, people who had the foresight to pull out of those when they were still at their highs, and maybe now when there's kind of like a rebound happening on certain stocks, pull some of that out and then have that liquidity ready and available.
We had that investor that we met with in Minneapolis
Yeah.
who he did just that. He had the same feeling. And he was like, I have all this money in my IRA. It's in traditional equities. I'm not going to do anything with it, but I'm just going to pull it out of those holdings. I'm going to sit it in cash in my IRA and make a judgment call. And he's going to have benefited quite a bit and create a little bit of wealth for himself by making that one move, just because he was able to foresee a little bit of uncertainty playing out in his benefit.
So people who did maybe follow exactly what we're talking about and pulled, a substantial amount of funds out of like the stock market, how can they use multifamily to continue to generate cash flow?
Yeah, I mean, I would say, and with my career, the folks that I've learned from people who have mentored me, one of my most recent mentors, Danny Catan from PIA, who I used to work with, he was the partner in charge of capital markets. He went to Wharton and studied under Peter Linneman. So he always would show me Peter Linneman's letter, and I started following Peter Linneman because I was like, oh, okay, this is someone I should be listening to. And he does a quarterly podcast with Willie Walker, who is the head of Walker and Dunlop, big brokerage firm.
Yeah.
And he made such a cool point in this last quarter podcast that I watched the last few days ago. And he basically said, if you look back 10 years, there were 2 to 3 years that were really, in those 2 to 3 years, if you invested in real estate, it didn't do well, no matter who you were. And if you go out 20 years, you're looking at 4 to 6 years of those 10 years where it was just an awful time to invest in real estate, no matter what you were investing in, probably didn't fare too well. And if you go out 30 years, it was like 6 to 7 years where it was just an awful time. He's like, so if you look at this from a statistical outlay, over a 30-year period, there's going to be 6 to 7 years historically based off of data where it's not a good time to invest in real estate if you're doing it the right way with the right people. 2021, 2022, first half of 2023, you could argue some parts of then to 2020, depending on debt structures you used. Really awful time for real estate now having hindsight.
Right.
Okay, so bear with me. 3 years, 2.5 years, awful time to invest in real estate because you were buying at a high basis. It was frothy. Stock market has been in need of a correction. You got 3 years out of the way. 27 years in the future, there's going to be 3 years that are a really poor time to buy real estate based off of statistics.
Mm-hmm.
And the other 3 have already happened. So you can kind of forecast out. And typically what happens is the years preceding the years that were tough are really good.
Yeah.
And that's kind of, one of the things that Viking has really focused on. So I think if you had a crystal ball or a time machine and you could go back to 2018, 2019, I would say you invest in real estate up until the middle of 2020, and then you start putting your cash into traditional equities. And those people would have really hit the rise in equities, hit the rise in real estate, avoided the 2 to 3 years that were not a great time to invest in real estate. And now it's take your chips off the table in traditional equities, let the markets balance out, and put your money back in real estate. Because
Something a little bit more stable.
Real estate's already been hit so hard that its path is up. It might take a little bit longer than folks expect. We hope that it's quick, but it's on its way up and not on its way down.
Yeah.
And the trends that you see, if you follow the trends, the super trends in real estate, all support that. And I think it's just a matter of time. It'll take a couple years for people to get over the PTSD of investing in a deal in 2022 with variable rate loans. But right now, you're able to buy pretty solid deals at a 5.5 or a 6 cap that shouldn't probably trade there because they have good underlying fundamentals. You slap 7 to 10 year fixed agency debt in the low 5s, and that is the perfect equation for a real estate deal to make a lot of sense over the whole period.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing. With a team of seasoned real estate experts, Viking Capital conducts deep financial analysis and data-driven asset management to deliver outstanding returns. Their strategy focuses on low-risk opportunities with significant value-add potential, preserving your capital while maximizing long-term growth. Join them and be part of a success story. Viking Capital has acquired 30 properties and manages over 6,000 units, all thanks to their dedicated team and valued investors. Discover their current deal offerings at vikingmultifamily.com and start your journey to financial freedom today.
How important do you think, in general, but especially right now, is it for the underwriting to be more conservative for sponsors?
It has to be. And I understand, and I think, Viking was guilty of this in 2020 and 2021, and parts of 2022, where you always look at the data and you try to be conservative based off of the data. Now, looking back in time, it's very easy to go back and say, okay, in 2020, debt was so cheap that you had 2 kind of converging themes. One was you could underwrite a deal and 70% of the purchase price was historically low cost of capital. You also had instruments like variable rate loans from debt funds or insurance companies that were levering things up to 80 or 90%. And from 2018, 2019, all the way through the beginning of 2022, middle of 2022, if you bought and sold, you killer returns. It was a really great scenario. When the Fed raised rates as quickly as they did, which was historically unprecedented,
Right.
It created a game of musical chairs where the music just suddenly stopped. And if you didn't use fixed year, 10-year debt, and you were using a variable rate loan with a rate cap, what you were hoping for was that rates would come down sooner than they have. We've lived in higher for longer for how many years?
Yeah.
And they're still not down. they're probably never going to get low at where they were without some kind of big debt jubilee, system breaks. Fed has to quantitatively ease and create a bunch of low interest rates and things like that, which is unlikely. It looks like they've done an okay job of
Balancing
stretching out the pain.
Yeah.
And it doesn't look like there's going to be some hard stop, but who knows? It could happen. There's people on both sides of the coin. But in any event, what you have to do when you look back at some of your models from 2020 and 2021, and you had 3% or 4% rent growth, and then you lived through 21, 22, 23, 24, where rent growth was flat to negative, you have to go in, and as you're building models in the future, even though you think things are trending up, we might get back to 3, 4, 5, 6% rent growth. You can't bank on that. And you probably shouldn't have banked on it then, except the 3 to 4 you put in your model was conservative compared to the 10 to 15% that you saw on site because of how rampant inflation got.
Right.
So like the really smart real estate sponsors understood that was temporary and that was going to come crashing down, because in addition to the high inflation, you had a huge wave of supply. And I think that's a mistake that Viking, made some of those mistakes, and we'll never make it again. We're shoring up those deals at a big, expense to Viking. And I think we're a better company for going through that adversity. But now that we're in 2025, it's really easy to look back and say, oh, man, I wish I would have done this differently.
Right. So speaking of 2025 and the economic landscape that we have, going on, the current market landscape, how do you feel? Like, I would like to set some expectations for listeners. So people who are looking at multifamily deals right now, and they're, man, I want to look at deals with X amount of cash flow or X amount of appreciation. I feel like some people, you're talking about these years where there was this, like, I think, out of the ordinary for what people were able to truly get. And there has become a rebalancing. But what are you seeing? I mean, Viking and the acquisitions team and you guys see so many deals. They come through you guys, and you guys are making sure that you're finding the right one for our investor buy box. But as far as kind of like a floor or like a general base, what would you say is like a true expectation for what people should see if people are underwriting conservatively and are making sure that it's the right deal? Because I want to preface that with the fact that there are a lot of times you'll see people put numbers on these marketing things that are just so outlandish, or trying to match maybe what they saw, what they could do before. But a lot of that is definitely 100% not like accurate, or they're really stretching to try to get, people to say yes to it. So I just wanted to preface with that.
Yeah, no, I think, and that's something that, we, in our evolution of a company, we kind of fell prey to that too, where we would build a model and we would want to show the base case, but also show, what it could be. And we always kind of try to figure out the best way to do that. And, I instituted performer reviews and going through the numbers where I can show people sensitivity tables and show what it looks like to get to a 2X, but also what it looks like if there's no rent growth, or, we don't sell at this cap rate. And I think probably the right way to do it. I think the idea that anyone is going to look at a model in today's market and say, in 3 years, I'm going to give you a 30% IRR. Like, you have to be a little bit skeptical. Like, those deals exist. Maybe they're buying a defaulted deal from the bank and they're getting it at a ridiculous basis. And, they're putting a ton of GP equity into the deal and there's not much LP equity. There's ways for that to happen. I would be skeptical. I think what you need to look at, and the way that we handle our investment committee, as of today, we did one the other day for a deal that we hope to acquire, is back to basics, back to fundamentals. We're targeting a flight to quality, and it doesn't necessarily have to mean that it's a 2020 asset or a 2015 asset. It even be an 80s asset, but it's in an A area. It's not in a crime-ridden area. The property has been managed by an institutional owner. You want something that's been taken care of, and that has a good tenant base, that you're not going to get in and the rent roll is all messed up because there's a bunch of hidden things that you had to figure out post closing on the deal. So that's where we're at. And I think for us, when we look at the model, for it to make it out based off of my chats with over 1,000 investors that invest with Viking, we need to be able to have strong conservative underwriting that's landing between a 12 and a 14% IRR. In a 5 to 7 year hold, be able to get, somewhere between a 1.5 and a 2x, and a lot of safety built into the deck structure. So
and what kind of cash flow are these people looking at?
It's typically somewhere between 3 and 6%.
Okay.
And for the right deal, maybe you do a little bit lower cash flow for a deal that maybe you're sacrificing a little bit on. It's not an A area, it's a B area, and it's not a 2010 property, it's a 1996 property with a strong value add. Maybe you're getting a little bit more cash flow, and it's really just in everything that you do, just like we talked in the beginning of this conversation, it's the risk reward. Really taking a look at the rent roll, quality of tenant, really taking a look at the deferred maintenance, what's been done on property, how much are we going to have to put into it. And then I think one of the big things that we're going to be adding into all of our investor conversations, now that we've gone through 22 and 23, we've had some assets that we've had to put more money into, that we've had to renegotiate loans with lenders, is really make sure that we're talking to investors and explaining to them the downside scenarios and what happens if certain things happen. How safe is the cash flow? What would have to happen for the cash flow to be paused and for the property to be able to support itself? And I think those conversations, like, investors are reasonable. And if you set expectations properly before they give you your money, then it leaves a much better taste in everyone's mouth if they have those expectations going in.
Well, I want to ask you one final question. So I think you have given such an incredible, overall investment strategy, overlook on how cash flow works. But what would be one piece of advice for somebody who's looking, maybe they're vetting deals right now and they're trying to figure out where do they put their money in this moment? Is there a piece of advice you'd give people looking in this current market?
Yeah, I would say, and I feel like we're people in this current market that are looking, and the advice I'd give myself is be patient, look for value, and work with people that you trust. Work with companies that you trust. If you think that a company is going to be around for 10, 15, 20 years, choose that company even if they're going through adversity, because you'll build better relationships, you'll get better access to deals, you will figure out how to grow with them. And not every year is going to go gangbusters.
Yeah.
Some years are going to be lean. I've never met an investor that's been investing for 10, 15, 20 years that has never lost money or gone through a challenging deal. And what all of these investors tell me is the people that I continue to invest with are the people that impressed me during those times.
Absolutely.
And that's what I tell my team is, Viking has gone through some adversity. We've had to do a capital call. We've had to renegotiate loans on deals. And all of the investors that get a personal call from me, that we don't just disappear when something happens, that we communicate. Those types of sponsors, whether they're new sponsors, old sponsors, but you build those relationships, and that's where you want to stay and continue to strengthen those relationships.
Yeah, absolutely. Well, I appreciate you all tuning in again. And Christopher, thank you for all of your wonderful insights. We appreciate them.
Of course, anytime.
And we're excited for the next episode. We will see you then.
Thanks, everybody.
Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.